You're lying in bed at night, phone glowing against the ceiling, thumb scrolling through real estate apps you probably shouldn't have opened. Every house that doesn't look like it's actively falling apart costs 700, 750, sometimes $800,000. You tap one listing. The photos are professionally staged, but you can tell the kitchen hasn't been updated since Obama's first term. Beige carpet, builder-grade cabinets, a backyard that's basically a rectangle of dirt. And still, the price says $750,000. You blink, you scroll back up, you scroll down again, and you feel that familiar tightening in your chest, that quiet question creeping in. Am I behind? Did I miss something? Is everyone else secretly making way more money than me? Or has the housing market completely lost touch with reality? Here's the uncomfortable truth most people don't want to say out loud. It's not that you're bad with money, it's not that you didn't work hard enough, and it's not that you failed at adulthood. The math itself has turned hostile. And once you actually slow down and run the numbers honestly, without optimism, without social pressure, without the voice of a real estate agent whispering, "This is normal," the picture becomes very clear, very fast. A $750,000 house in 2026 is not a stretch goal for most Americans. It's a financial cliff. Let's start by grounding this in reality. In many parts of the United States right now, $750,000 is no longer luxury. It's not a mansion, it's not waterfront, it's not gated. In cities like Phoenix, Denver, Austin, Raleigh, parts of Florida, New Jersey, California suburbs, even Midwest metros near job centers, $750,000 buys what would have been considered a perfectly average family home a decade ago. 3 bedrooms, 2 baths, maybe 1,800 square feet if you're lucky. This price point has quietly become the new normal. And that's exactly why it's dangerous. Because when something becomes normalized, people stop questioning whether it actually makes sense. Now let's talk income, because this is where the disconnect starts. The median household income in the United States hovers around the mid-$80,000 range. Even households doing well by most standards, dual income professionals, are often landing somewhere between $120,000 and $150,000 a year. That sounds like a lot. On paper, it is a lot. But income doesn't exist in a vacuum. What matters is what that income has to support. And when you compare incomes to home prices, the ratio has quietly exploded. Historically, a healthy housing market meant homes cost about 3 times household income. 4 times was pushing it. 6 times? That's not aggressive, that's destabilizing. A $750,000 house is roughly 9 times the median household income. That alone should stop the conversation. But it usually doesn't. Because this is where the system steps in and reassures you. The bank says you're approved. The mortgage broker smiles. The loan officer tells you your payment fits within guidelines. Your parents say, "We figured it out, you will too." And so you assume affordability means approval. But those are not the same thing. Approval is about whether the bank thinks you'll default. Affordability is about whether you can live your life without being constantly stressed, reactive, and one emergency away from collapse. Let's walk through the numbers slowly. No fear, no exaggeration, just reality. A $750,000 home with a traditional 20% down payment requires $150,000 in cash. Not investments, not retirement accounts. Cash, sitting somewhere liquid. For most households, that alone ends the discussion. The median savings balance in America is still shockingly low. Even high earners often don't have 6 figures sitting around untouched. And saving that amount isn't trivial. If a household somehow manages to save $15,000 per year, which is ambitious, it would take 10 years just to accumulate the down payment. And that assumes home prices don't continue rising, which historically they tend to do. So most buyers don't put 20% down, they put 10%, sometimes 5%. That means on a $750,000 house, you're borrowing roughly $675,000. At interest rates hovering in the 6.5% to 7.5% range, which is not extreme by historical standards, your monthly principal and interest payment alone lands somewhere between $4,200 and $4,600 per month. That's before you've paid a single dollar to actually live in the house. Then come property taxes. In many states, property taxes on a $750,000 home can easily run $8,000 to $15,000 per year, depending on location. That's another $700 to $1,250 per month. Homeowners insurance has quietly exploded over the past few years. Fire risk, flood risk, storms, replacement costs. It's not unusual now to see premiums of $300 to $500 per month on homes at this price point. Maintenance, the invisible cost everyone ignores until something breaks, should be budgeted at about 1% of home value per year. That's $7,500 annually, or over $600 per month. And if you put less than 20% down, you'll also be paying private mortgage insurance, which can add another $300 to $500 per month, depending on credit and loan structure. Now, stack it all together. Mortgage, $4,500. Taxes, $1,000. Insurance, $400. Maintenance, $600. PMI, $400. Your total monthly housing cost is now hovering around $6,900 per month. That's not worst case. That's not luxury upgrades. That's just the cost of existing in the house. So now comes the real question. What kind of income supports a $6,900 monthly housing cost without turning your life into a constant math problem? Traditional financial guidelines suggest housing should stay under 28% of gross income. Some banks stretch that to 36%. Others go all the way up to 43% because technically the loan can survive. But survival is not the goal. Stability is. At 28%, a $6,900 housing cost requires a household income of nearly $295,000 per year. Even at 36%, you're still looking at around $230,000. And if you push to the bank-approved edge at 43%, you'd still need roughly $190,000 in annual income just to avoid immediate suffocation. That puts true affordability firmly in the top 10% of U.S. households, which means for the vast majority of Americans, a $750,000 home is not affordable by any reasonable stress-adjusted definition. And yet people are buying them. So who are they? Some are dual-income professionals in tech, medicine, finance, or law. Some have family help. Some rolled equity from earlier homes purchased when prices were lower. And many quietly are stretching themselves to a degree that would terrify them if they actually saw the numbers laid out honestly. Let's make this real. Imagine a household earning $180,000 per year. That's a strong income. That's successful by almost any standard. After taxes, health insurance, and modest retirement contributions, they might take home around $10,500 per month. Now subtract that $6,900 housing cost. They're left with $3,600 for everything else. 2 cars, insurance, gas, groceries, childcare, student loans, utilities, phones, internet, clothing, medical costs, savings, life. That margin disappears fast, and once it's gone, stress fills the gap. This is where the emotional cost shows up. It's not dramatic. It's quiet. It's checking your account before buying groceries. It's delaying dentist appointments. It's dreading home repairs instead of seeing them as normal maintenance. It's saying no to opportunities because you can't risk any disruption. It's living in a beautiful house while feeling financially trapped inside it. And this is the moment where most people start blaming themselves. They think they're bad with money. They think they're undisciplined. They think if they just budgeted harder, it would work. But budgeting can't fix a structural mismatch between income and fixed costs. You can't spreadsheet your way out of a broken ratio. Midway through this conversation, this is where I should introduce myself. My name is Salvo, and I spend an unhealthy amount of time thinking about the gap between what we're told is normal and what actually works financially in the real world. Not in theory, not on social media, but in the quiet moments when the bills hit and life happens. If you're watching this and feeling that low-level anxiety in your chest, the sense that something doesn't add up, you're not imagining it, and you're not alone. Here's the part no one benefits from explaining to you. The housing system doesn't care whether you're comfortable. It only cares whether you can keep paying. Banks structure loans to survive defaults, not to protect your peace of mind. Real estate agents are paid to close, not to stress test your future. And culturally, we've turned homeownership into a moral achievement, even when it comes at the cost of mental health and financial flexibility. Being house poor has been normalized. We joke about it. We call it adulting. But the long-term cost is enormous. When most of your income is locked into a single illiquid asset, everything else in your life becomes fragile. Job changes become scary. Career risks disappear, investing slows, emergency funds never quite recover. You're not building wealth, you're defending position. And here's the brutal irony. The house that was supposed to make you feel secure becomes the reason you feel trapped. This doesn't mean home ownership is bad, it means timing and price matter. A house only builds wealth if you can survive the payment long enough to enjoy the appreciation. If the payment consumes your ability to invest, save, and adapt, the math flips. You're not building wealth. You're renting money from a bank at a premium. The hardest part of all of this is emotional. Watching friends buy homes, seeing social media posts, feeling left behind, feeling like renting is failure, but comparison hides context. You don't see their spreadsheets, you don't see their stress, you don't see the credit card balances quietly rising behind the scenes. There is no prize for buying a house that breaks you. There is no trophy for stretching into a payment that dominates the next decade of your life. The goal isn't ownership at any cost. The goal is stability, flexibility, and the ability to sleep at night. For many people in 2026, that means accepting an uncomfortable truth. A $750,000 home is not a starter home. It's not even a middle-class purchase anymore. It's an upper-income commitment. And pretending otherwise doesn't make you optimistic. It makes you vulnerable. You are not failing if the math doesn't work. You're doing the one thing the system discourages. You're thinking. Sometimes the smartest move is waiting. Sometimes it's renting and investing the difference. Sometimes it's choosing a smaller home, a different market, or a different timeline. Sometimes the bravest decision is saying no to something everyone else insists you should want. Because real wealth isn't granite countertops or open floor plans. Real wealth is margin. It's options. It's resilience. It's the ability to handle life without panic. And the most dangerous lie in housing today is the idea that approval equals affordability. It doesn't. The math doesn't care how badly you want it, but it will reward you if you respect it. If this video made you pause, if it made you reconsider what affordable actually means, share it with someone who's staring at listings right now, wondering what they're missing. You're not missing anything. You're just finally doing the math. And sometimes doing the math is the most powerful move you can make.